Welcome to the ESOP Guy. We are on a journey to an ESOP. So glad you guys could join today. For those that are joining for the first time, this podcast is really a resource that we've created to really help folks think about and determine whether or not an ESOP, an employee stock ownership plan, would work for their businesses. And so for each podcast, what we do is we just take a topic and we try to dig into something that's specific that would be what we think is a good learning exercise for folks that are thinking about ESOPs. So today, what we're going to talk about is the idea of being either an S Corp or a C Corp, but really having the complexity of having real estate in the company prior to the transaction and what that creates. And so once we start working on an ESOP plan, at the very beginning of the very first step is really identifying the right entity structure so that the actual sale of an ESOP can be done correctly. And what we find is that sometimes with real estate in the company, it can be very complicated. So to do that, I've invited two of our very experienced tax partners with Berman Hopkins, and that includes Jim LaHam and Justin Knox. And what they're going to do is help us kind of walk through the whole tax side and just really better understand this topic and really get into kind of some of the solutions behind it too, or some of the things that we see in the planning sides that I think will be really helpful. So with all of that, I just want to kind of remind everybody, go to our website at journeytoanesop.com for all of the episodes. And as we go through this topic, you might also want to share it with a friend because you might know somebody that's thinking about doing the ESOP. So with that, I want to say thank you guys for joining today. I want to start off in welcoming you to the podcast with asking you really kind of a question I think is really important. What is your favorite movie and why? And you have like just a brief amount of time to tell us.
Okay, there you go, Jim. What's your favorite movie?
You know, that's an impossible question. I get this asked and I see 2 movies a month, even post-COVID. And, you know, I'm at a loss every time to pick out a movie that is just so far superior to anything I've seen. You know, I saw the Maverick movie just recently, so you tend to like what you just seen. I saw Bullet Train, that was pretty funny with Brad Pitt. So I just have to say I would have to really think through this for a long time to pick one movie because I'm such a movie person. So I'm going to have to leave it at that. The last 2 movies I liked a lot were Bullet Train and the Top Gun movie.
There you go.
Perfect. I knew you couldn't answer that question. I know it's like impossible questions.
It's like your favorite book. You know, it's just hard to do if you read a lot.
All right, Justin, what about you?
So funny movies that I would quote a lot would be Wedding Crashers to this day, and that's getting old. So I love that movie.
Excellent.
And then one day the kids will be able to watch it too, but not yet.
Like when they're 30.
That's right.
Right.
So great. So thank you guys for joining. And as I said, you guys are our tax partners. We have other tax partners, but you guys are focused on ESOPs and really helping me stay out of trouble, which is really good. Just briefly kind of talk a little bit about your background with the ESOPs. And I know, Jim, you've been doing it for a long time. And I know Justin and I've been working together for several years now. So.
Yeah, we sure have. I mean, I believe, Jim is really the person that introduced both of us, because I think about 2014 was when I started working on these with Jim. We were coming out of the recession. Transactions were starting to occur, and this is one of the main main succession planning tools that can be utilized. And it's gone from there. Wouldn't you agree, Jim?
Yeah, I've started with ESOPs with Deloitte literally back in the late 80s. I put in one of the first ESOPs that Deloitte had ever done because it was pretty new on the street. And I brought that to Berman Hopkins when I started here in '89 as an area of expertise that I didn't want to pass up. So we did lots of Central Florida ESOP transactions here since that time. And then, of course, Justin started working with me, and he's become an expert of sorts in this as well. And I coaxed Phil into getting into this as a real deal from a business development side and just a consulting side. So much fun to deal with, and a tool that's so underutilized because people think it's too complicated, but it's only too complicated if you don't hire the right people that understand ESOPs, because they're a little bit complicated, but they can be an incredible exit strategy in the right circumstances.
Absolutely. Yeah. And what's cool about the ESOP world is there is a lot of tax that you have to figure out. And I know we've been, as a firm, involved in it since Jim really has started the practice along, in terms of our tax practice. But on the tax side, though, as we get into the topic, one of the things you find, and the reality is that even though we're a CPA firm and we do this for our clients, primarily the ESOP work that we do, for at least what I do as far as helping companies create ESOPs, mostly they're companies that don't actually are not actually our clients. Their clients are all over the country. They have their own CPA, which is fine. We end up working kind of in tandem with their CPA, and so it's, you don't know exactly what the CPA has done relative to their tax planning. So when you do start planning with a new client, the first thing that we look at is their company structure and their entity structure. So whether they're an S Corp or a C Corp, whether they're an LLC, taxes an S. So we're looking at that structure to determine, how they're going to transact. And in an ESOP, you only can transact as an S or a C. But deeper than that, we're also looking at the balance sheet and what's on the balance sheet. In some cases, we find that there's real estate in the balance sheet. So there's land and building. The company has either acquired the land and building, the owner wanted to keep it in there for various reasons. What are some reasons people would, from a tax planning standpoint, actually want to have real estate in their businesses instead of holding it in a separate company and leasing it back to the company, which is predominantly structured?
I think the only good reason I can think of, living here in Florida, is we have the commercial rents tax, which is sales tax on commercial rentals, which is unusual. I mean, Florida is a very business savvy state, but they're reducing that rate, but still somewhere between 5.5–6%. So I have recommended in certain instances, very reluctantly, but in certain situations, it does make sense to have the real estate in the business. Also, some businesses, for example, auto dealers, typically they sell everything together, which includes the dealership property, which is very, very integral to their whole business situation. So those typically go anyway with the transaction. Other businesses, I think, in the big capital world, a lot of businesses don't want the real estate when they make acquisitions. I mean, Walmart doesn't hold their land, CVS, Starbucks, they all have developers that do the land and do the leasebacks. So they can be problematic in a lot of businesses. But to answer your question, that's the only good reason I can think of in Florida here, is you avoid a significant expense that you can forego by putting it in the company.
Mm-hmm.
That's correct. And with the formations of LLCs, and they probably being the strongest form of ownership in the state of Florida, when it's in a multi-member environment, that can be taxed as any type structure. Either the disregarded entity or the partnership type environment are the most friendly tax-wise, because of this, what we call an appreciated asset problem. It's any type of appreciating assets, real estate, investments, and other forms of intangibles. And unfortunately, in a corporate tax setting, S Corps or C Corps, if you distribute these type assets, it's going to trigger a form of tax that's very hard to overcome. And we may have a couple of strategies, but we come down to the fact that specifically to an ESOP, you have to sell corporate stock, and we don't have the flexibility to sell assets in this case, meaning we run into some issues where we're going to trigger some tax if we don't think through it. How do we offset that tax is the better question.
Yeah. So let me lay out the problem a little bit deeper too, because I think the planning side is, as you mentioned, an ESOP sale has to be a stock sale. We can't buy the assets. And in the planning process, if you're going to sell the real estate along with the operating entity, then you have this mismatch of cash flows, which means I'm buying the asset of the cash flow of the operating entity. I'm valuing that asset, but on top of that, I have to get an appraisal of the real estate and value that asset. and I want to buy the company as an ESOP. I want to sell the company for that cash flow to kind of turn and pay that debt back. And so that we can kind of get into other things that the company wants to do. So the goal of the ESOP is to buy out the selling shareholder. And so if I add real estate on top of it, now I'm going to have to structure a debt amortization around that. That's going to have a long-term amortization. So I've got this funky debt schedule in the cash flow, and it makes a little bit difficult because you do want to get out of debt quicker than later, or sooner than later. And so part of it structurally, it just works better when the real estate's not in there, in my opinion, in putting deals together.
Yeah, I think I answered the only one reason I've ever found to have it in the entity is for sales tax purposes. And Justin pretty much described he can't think of any. So the reality is, if you're in putting together a company, keep your real estate separate. You might not think about it now, but it will become a problem, or at least a challenge into the future when we try to sell the business. So I would say, yes, keep them separate. It gives us so much more flexibility, but we have some thoughts on those companies that have done it, and that's the way the way the world is. Some people have done it for a variety of reasons, and now when the time comes, we got to figure out how to split those assets off.
And that's kind of what this whole podcast is going to be about, is like, here I come down the hallway asking Justin and Jim, hey, I've got a company that's got real estate in their balance sheet. And is there a magic pill that I can pull out the real estate and not have this taxable event for the selling shareholder? Because in their minds, they didn't do anything wrong. I mean, they probably did it with all good intentions, but now they're trying to do a transaction. And then you start looking at the ramifications of doing the ESOP transaction, and we want to separate it. So I'm knocking on your door saying, hey, is there a magic pill here? Is there a way to do this that is let's just take the S corporation environment, and then maybe we can go into the C corporation. And I think they're fairly similar, right? When it comes to
fairly similar when it comes to these rules.
So why don't we answer this by, Justin and I have come up with two, I think, workable strategies when you have real estate in the business that is problematic, and we have to get it out. And I'll answer one strategy, and then I'll let Justin answer the other one.
And you know what, we could almost start, Jim, when we discuss this topic, that most might come to mind if they've ever been through reorganizations. We talked about, could you spin the real estate out? But unfortunately, that's not a qualified spin out, correct? Just spinning the real estate isn't a qualified reorganization to try to get it out into a new S corp.
Yeah. So the first question that comes up often is, well, I'll just spin it out. We'll spin out the put the asset in a new corporation, then spin it out to the shareholder. But the IRS and Congress has said that's not considered a business unto itself, and to be a qualified spin-off, it has to be a trader business, and they don't consider a rental property a trader business for this purpose. So that leaves us, and I'll speak to the first strategy, which is if you distribute an asset out of the company, it's a taxable event at fair market values. If you purchased it at fair market value, and it's going to trigger a gain, let's take an S corporation at the S corp level. So that's a reality. We don't really see getting around that. But an offset to that, at least in the current environment, when Justin and I thought through this, is, and we've done this recently, it says, well, maybe this transaction is not as bad as you think. You're gonna push the asset out, and you're gonna pay a gain on the difference between the basis in the company, what you got left after your depreciation, and its fair market value. And if you get a sensible value on the fair market value, on the lower side of an appraisal, you're going to pay tax on that difference, largely at capital gain rates. So now think through it, though. It usually stops there, and everybody says that's a terrible result. I'm not going to do that. So, well, think about it a little bit. Now you have really acquired a new asset after the distribution, and you have the ability to put that through a cost segregation study. And your depreciation is going to come through largely at a 37% rate, the worst case, a 30% rate. So you're actually going to be trading capital gain rates of maybe, let's say, 22% for a deduction that's going to be somewhere between 30 and 37%. And these cost seg studies will often generate maybe 30% of that building, depending on how complicated the building is. A manufacturer would be much more than an office building, but about 30% of that cost basis in the building is currently going to be eligible for bonus depreciation. So in $1 million building, that's a simple example, you may be able to write off 300,000 in the first year. Now you kind of link that up with your capital gain, and it kind of works out pretty well in the long run. So it may not be as terrible as you think.
Let me ask you a quick question, because I think we have to assume people don't know what a cost seg is, just so you know.
That's good. You're right. The jargon.
Yeah. So briefly, I'll just say, let me go backwards just a second. So the whole business purpose is we pull the real estate out and we're going to rent it back to the operating company. And in the ESOP transaction, what the owner is going to get this ongoing stream of cash flow from that rent. And that rent's going to be a fair market value rent. And that's going to be a good structure, because they're going to get the sale of the business plus the rental income. And then over time, that's a good stream of cash flow for both those sources. So it's got a good business purpose. But what Jim's talking about is, if you pull the real estate out and it was in the company, and we're talking about an S corporation right now, then you can also then take it out and put it in a new entity, and then do a study on the assets, the permanent assets in the building, and accelerate the depreciation from 39.5 years down to, say, 15 or 12 or something, based on an engineering study that shows that you can accelerate that depreciation. And then what you're going to do is be able to write off an X amount of depreciation annually against that income. Is that basically the play?
That's a good synopsis.
Now, so real quick, my question is, what if in the S corporation they've already done a cost seg?
Well, what you really have is a new transaction, because when it goes out, it's as if you purchase this asset at fair market value. So you start fresh. And the cost seg thing for our viewers is, when you look at a building setting, the things that we write off quickly are, there's going to be some equipment embedded in it. So that's 5-year property. There's some equipment. There's going to be landscape lighting, parking lots, landscaping. All of that stuff can be written off in very short periods of time, and some are eligible for bonus depreciation. So the point here is, even though it seems like a drastic transaction at the beginning is going to create this capital gain tax, remember that's a low rate tax, but you're trading it in for a high deductible and rapid depreciation situation. Now, I would finish it off by saying, okay, now you have this building, and you've taken the rapid depreciation to mitigate the taxes at the year that you take it out. But then if you want, you have a building that's theoretically debt-free, is you can then go to a bank and leave enough equity in it and say, now that I have basis in the building, I can strip some of the equity out. Right. So in my $1 million example, I may be able to go back and we kind of describe this as pre-selling the building by, let's say, taking out a $600,000 mortgage and just taking that money and doing what you see fit with it.
Because this is very typical of what rental real estate professionals do all the time, versus selling the property for the long run. They'll refinance the property and take out the appreciation. And they can do this multiple times, as you mentioned, Jim, as long as they have a long-term lease involved.
So it's not as dismal as you would think, I think, and that's why you have to deal with somebody that really understands some of the nuances of these, what would be considered a problematic asset, like real estate. So why don't you talk about, go ahead, Phil.
Before we move further, talk briefly about the concept of when they take it out, they get this step up in basis. So in the new entity, explain what that is, because people always say step up in basis, and I just like people to know like the basics.
So let's say you had a building that was depreciated down to 200,000 and it's worth $1 million. I know that's probably understated in today's marketplace, but for simplicity. So when you distribute it out, you have an $800,000 gain in the company. The individual picks it up at $1 million because he got a value of $1 million of property. So he picks it up on his personal side at $1 million, and then it's considered a purchase, an acquisition. So that the individual can do whatever he wants with it. Likely would put it into an LLC, maybe a disregarded entity with his wife, And then he has all the ability to use a cost segregation study to maximize depreciation currently and do whatever they want with it in terms of stripping some of the equity out in a refinance.
Great.
So twofold, we could get the typical cost segregation, breaks the building into components, as was mentioned before. If we could break out 20 to 30% of it in the shorter lives, we have bonus depreciation per se that's eligible for that advanced depreciation. Jim mentioned maybe in the first year you might have close to a $200,000 or $300,000 deduction that could be worth almost $100,000 tax shield. And when you're looking at a couple $100,000 in tax, a tax shield of maybe 100, maybe there's a net 100 out of pocket that we're talking if you're just looking at the tax piece. And if people are trying to associate a cash flow, as typical real estate developers are, if they don't want to sell their property, you could potentially refinance it for the increased fair market value, have a cash stream that paid for those taxes, plus have additional equity in your pocket that you could spend.
Sounds good. So going into that, in terms of having it in the S Corp, that's where the real estate is. If you just, and this is probably a crazy question, but if you had a holding company, and then in the holding company, you had separate entities, one was a real estate entity, one was your operating entity. Can you sell that operating entity and then leave that holding company with the real estate there? Can I sell that stock down here? Is that possible?
It's a good question, right? It's a good question and a tough question. It's a subsidiary, and in the S corporation environment, any subsidiaries, unless they're separate partnerships, but if you sell that, if it's 100% owned subsidiary, it's considered selling assets for federal tax purposes, because a Q sub is completely disregarded for those purposes, and you would have to recognize the appreciation. But in this case, you cannot sell assets to.
No, I can't sell assets. I have to sell stock.
So you can't buy that subsidiary. You'd essentially have to buy the holding company to make the ESOP transaction valid.
Right.
I don't quite understand that, why it results in that, but that's kind of what the tax thinking is now, because it's really a corporation for every other reason, but and this is kind of complicated tax talk, but it's considered a disregarded entity for tax purposes, which means it doesn't exist as a corporation. So that's why it doesn't work, because for tax purposes, you're buying assets, not stock. So you have to go up and buy the holding company stock to make it qualify.
This is one of those rare instances I've seen even in your deals, Phil, where if a company is an LLC, taxed as an S corporation per se, a lot of times they'll form a holding company that's specifically an Inc. to sell to the ESOP, so that there's no questions that corporate stock is being sold, so that it's qualified property going into the retirement plan or the ESOP.
Now, Justin, what do you think if it was a C corporation that had a subsidiary? Don't have that disregarded. I'm not certain of this answer, but it seems to me a subsidiary in a C corp environment is a real company. And you may be able to then go in and buy the operational company there. That may be an advantage to having a C corporation environment with a holding company, that you could go in and buy just that legitimate corporation in a C corp structure.
We could potentially do that, and we haven't worked through that scenario, but we could work through that scenario. But typically, we don't see the C corporation environment unless we're really looking for a deferral under a different code section.
Well, yeah, let's just throw it on as let's just go to the C Corp topic for a second, because I have another thought or question. So let's just say I have a C corporation, I have real estate in the entity. And as a C corporation on an ESOP, I can do the 1042 transaction, which basically means I can like-kind exchange the stock to this QRP, this qualified replacement property, and all my capital gains in that structure is going to be deferred into the QRP if I do it right. And then from there, I can pull it out of the QRP with floating rate notes, have 10% of the QRP secured by liquid assets, and then I can take 90% out with floating rate notes. So if I have a C corporation with real estate in it, and I do an ESOP sale, 100% transaction, is it feasible that I can completely eliminate or defer the capital gains on that real estate sale? If I sell the real estate in the transaction, let's just assume that I analyze it and I'm like, hey, by doing that, you can sell the real estate and the company and we won't have any capital gains. Would that be, what do you think about that structure?
Yeah, I think if the whole company goes in a 1042 transaction, a C corporation transaction, yeah, I think it just happens to be another asset in the C corp in the balance sheet.
Right.
You should be able to, you calculate your gain and defer all of it with replacement securities. That may be an advantage of being a C corp.
Right.
For sure.
I mean,
yeah.
and I guess really you're thinking that this deal would be easier to get done under a 1042 environment, even including the real estate, correct, Phil?
Yeah, because then there's this carrot of, whatever that, especially if you have, everybody always says it depends, right? So if you have a scenario where that real estate's, appreciated in tremendous value, so that capital gains is going to be a big number, then it could really make a big difference in the planning.
That could be a kind of a silver lining when you think you have a problematic situation. You're still going to have the capital problems of the entity having real estate now, because they're going to have to finance that all in the transaction. But and that kind of leads to a second strategy, that maybe what you could do if it all goes is the company now has real estate that's causing some problems because of cash flow, because they have to come up with all this money to buy it. And that, now the one strategy Justin and I thought about, it was maybe you approach a commercial developer that does these transactions all the time. And you say, look, we got an incredible asset here. We've got a building and a plant. We're willing to put it into a 10, maybe even longer lease, but we want you to buy it at fair market value for, let's say, $5 million. And when we'll lease it back over a 10 or 12-year term, some kind of term it's certainly going to have to be 10 years. So that infuses just a huge amount of cash into the now post ESOP transaction, that just kind of refinances the whole thing by going through the sale leaseback proposition. And I think that's a real opportunity in a situation where you have to do the transaction. The bank, as long as they understand you're in the middle of, as soon as you get this and get it underway, you're going to sell it to, Wall Street, some like a REIT or just somebody that invests in it on a regular basis, says, I love 10-year leases that give me an ROI of 12 or 15%. And so I'm going to structure the lease payment, but I'm going to give you all this cash. You'll get this up front to do other things, expand the business, get your balance sheet cleaned up.
Pay off debt immediately.
Pay off debt, yeah, right.
That initial ESOP debt, the bank would actually love it, because then they get, they get the fees on the deal and pay it off. Or no, I think that's a great idea. You could do that with an S corporation too, right?
Yeah, working both sides. And, it's something we haven't focused on, but when we were preparing for this, I think we both said, man, we need to bring this up, because there's a lot of real estate investors that like pretty much guaranteed rate of returns with really good tenants. And the real money is commercial tenants that, are real solid through thick and thin. And I think those buyers are always there.
Mm-hmm. Well, and not to mention, if it is an S corp and we went 100% ESOP, now you have an entity that can pay that lease back as a tax-free entity. So if all that cash came in and you paid your debt down, now you have an entity that doesn't pay taxes to pay the lease. So
and think of this too, you're selling that building that's highly appreciated, and the company has a giant capital gain after the ESOP does, but the ESOP doesn't pay tax. So
right.
that appreciation never gets taxed.
Yeah.
So I think it's something that we going to add to our toolbox as we start to work in the financing side and the tax side, for that matter, is something to really consider.
It's really good. Yeah, that's a good idea. So, and that's when you look at some of the planning things, you're like, well, it all seems like bad news sometimes, but if you can really work it into a better situation, somebody can really come out smelling like a rose.
And I think for those of you considering an ESOP, we've been doing these for a long time, and I've never wondered why they're not utilized more. So this is a little bit of a commercial perhaps for the firm, but we really do understand these transactions. We're experts in these transactions. Most practitioners, most attorneys do not understand this strategy, and they invariably say they're too complicated. And people listen to their attorneys and their CPAs who just don't understand it. Just not at all experts. I mean that literally. So oftentimes they just get stopped before they get started. So we're very open to these transactions. We understand the solutions, and I think you have to find somebody that really does understand the nuances of these transactions, like our firm does.
Yep. No, that's great. So basically with I guess the other issue, if we go back to just the C corporation and they have a piece of real estate, we don't do the lease back, or we just kind of have to pull it out. Is there any additional taxes that they would have that an S Corp wouldn't have?
Justin, give them the bad news.
Yeah, they would. In the unfortunate situation, you unequivocally want to keep it. The company would pay gain. There's no such thing as capital gains in a C Corp environment. So let's just say they would pay 26% if they were in Florida, federal rates plus Florida rates. Then when they distribute that property, it would be considered a qualified dividend to the shareholder, but it would be subject to the net investment income tax. So likely in these shareholders' income tax bracket, they'd be at 23.8%. So in order to sell it at fair market value and distribute it, there could be somewhere close to 50% tax on the transaction.
Now that's bad news.
That's bad news. See, I can't do bad news anymore.
No.
Jim gave you the bad news part of it.
There it is. So we better 1042 it is the answer.
Yeah, that is the answer. That is, you 1042 the whole thing. You sell the whole thing together, and then have them do the sale and lease back.
Correct.
That is it.
Yeah. Well, so I think we've nailed that down. When it comes to commercial real estate, I think a lot of those points are really good. Let's just quickly summarize some things on the cost seg I think are important to think about. I think my biggest point to kind of finalize everything we talked about is planning this, identifying this problem up front before you get too deep into your transaction. So going into and hiring a trustee and hiring the valuation firm and hiring the attorneys. And before you get into the deep waters of actually a transaction, you really want to lay this out with your CPA, with your sell-side advisor. You really want to have a very good understanding of what the tax implications are going to be. And that frankly is one of the reasons I like doing this from our place, which is a CPA firm, because we are much more CPA minded in transactions. When a sell-side advisor is not in a CPA firm, they're kind of relying on the company's CPA firm to do all this. But sometimes they just, like it or not, they don't necessarily do a lot of transaction work. So identifying this up front, making sure that you can navigate through it, because it's going to be a very big part of the net proceeds of the transaction. I think that's my biggest summary for what we just talked about. What about you guys?
Well, I think we've evolved as a firm as well. Our feasibility studies, I think now are more robust, or a little more, I would say, look at the entire transaction. Something like this, seeing the real estate in advance, we typically wouldn't have thought of that as a big deal. We just kind of look at what a transaction might look at. But I think now we would look at the feasibility side, looking at the real estate concerns in before we even go and start doing investing in a lot of other things. I think that's part of the feasibility study now, that you can to see whether it's a go or not a go before you go to. I think we still kind of go to the appraisal route first in our.
That's exactly how we go. Yeah.
Because we used to originally, clients would tell us what they were worth, and then we would invariably go down a feasibility study based on what they thought they were worth, and typically they're less than that. And then we would run into a problem with making it all work, because the value was not based on an actual certified kind of valuation analysis that would be much closer to actual market value. So you'd start with that, a good appraisal, see what you're really worth on the outside. And then you go into that feasibility analysis and have to consider all kinds of parts of, including problematic assets like appreciated securities, appreciated real estate, and kind of solve that up front before you go into the, the full-blown transactional analysis.
That's great. What about you, Justin?
No, I absolutely agree, because depending on the stage of the succession you're at, if you're late in the game, we have less options. If we're early in the game and planning for the succession and the type of tools, we likely won't run into these S Corp scenarios, or potentially we could have come up with strategies when things weren't as highly appreciated. So at this point in time, if it's imminent, we're going to sell in the next year, I think the strategies we discussed are probably the best plan of action. Had it been from the inception or a decade before, and your real estate's not worth nearly as much, potentially we would have already had that in a partnership environment, thought that through in your planning, and already had a cost segregation in place. So I think it boils down to where you are in the process. It emphasizes how important annual tax planning is, just for these facts, in case we need to get the real estate out now so that you don't have a problem in the future.
No, great. Well, thanks guys for joining me to do that today. I think it was really helpful in kind of covering a very specific topic that I think gets kind of missed sometimes. And when it does pop up, it can be pretty interesting or difficult. So with all of that, thanks for listening today. And we will look forward to our next step on this journey to an ESOP.
Thanks, everyone.